Meetup. So for those of you who know us, we do this meetup once a month and we meet in person, but these are unique times and we had the opportunity to meet you virtually and we took it. Hopefully next month, we're gonna do this in person again. But these are certainly some trying times. Who's been in a health crisis before? Not me. So I am just trying to stay focused and try and surround myself with good information, good data, most importantly, and see how we can survive this. We're going to come out of this strong. It's going to take a minute, whether that's going to be like 3 months or 6 months. We don't know that yet, but we're going to come out of this. We had a booming economy just about a month ago. So we're gonna come back and make it better. Again, my name is Leka Devatha. I'm gonna just announce some small housekeeping items. If you're just joining us, please mute yourself. We'd love to see everybody. So if you have video, love to see you. We do have a chat box. Give us some love. Tell us where you're coming from. And we'll try and get to any questions you have towards the end of the meetup once we're done with our amazing panelists. Nee, you want to introduce our panel?
Sure. So guys, we have 4 awesome guests here for you today. But actually, let me first start off with a quick poll while we wait for some more folks to join in the next couple of minutes. So let me kick that off right now. So you guys should be seeing about 3 questions. We'd like to get more insight about who you are and what you're seeing in the market as well. So in the meantime, I'll introduce some of our panelists. So we have 4 panelists today. They all have different specialties, right? And we're gonna go kind of in opposite alphabetical order and interview each of these panelists, give them basically 10 minutes of time to just talk. And then at the end of the meetup, we'll bring everyone back together. We'll do a live Q&A with questions that we collect throughout the meetup, throughout the event, and then they're all going to answer it. And so the first panelist that's going to go is Zack Lazo. He is one of the co-owners of Caliber Real Estate, and he's a real estate investor himself. He's done a lot of deals, and he's done a lot of deals for his clients. Right? He's a man of many real estate talents with eyes on a huge volume of real estate transactions. So he's going to be able to give us insights on the local real estate market and an angle that few people can provide. And then next up, we'll have Preston Walls. So Preston Walls is the founder and CEO of Walls Property Group and Walls Property Management. So he himself owns a portfolio of 75 plus buildings, which is over 400 units in core Seattle areas, and he manages a few hundred more for investors. So last month, if you went to our live meetup, we held it at one of his multifamily value add projects, and it was a great hit. And he explained the entire process from acquisition financing to what he's doing now and what looks like in the future, and how he raised money for it. And then because it was such a hit, we're going to do more of these in the future with his team, because he has other projects in pipeline throughout Seattle. And so it's a great thing to see in person. The next person we have is Charles McKinney. So Charles is the CEO and co-founder of Certain Lending. He's also a large multifamily and single family real estate investor himself in about 4 different states. And in his past life, he was an executive director at Freddie Mac. So he was the guy in charge of their loss department, right? I mean, if you guys want to know how to survive a crash, ask the guy who was in charge of the loss department at Freddie Mac during the last one. So he, all the prices that you see for Freddie Mac's short sales, auction properties, REOs, he's the one that set those prices. And that's about, you think about it, that's about 400,000 homes sold during the crash, during the peak of the crash. And then last, we have Albert. So if you guys have been around, locally here in Seattle, or even bigger pockets, he's a big value add guy, right? He posts a lot of really interesting things, especially when it comes to finance and mortgage planning. And he's been my go-to guy for the last 6 years when I have any questions about mortgage or finance advice. So another person who sees things at a very unique angle in the real estate market. And those are our guests. Let me end the polling here and see, did everyone take a vote? I think I'll give them another 15 seconds, and then share the results with everyone. There we go. So it looks like we actually have a lot of landlords in here, but also a decent amount of new real estate investors, and then a variety of folks, right? Most people are still, well, most people are thinking something's going to happen, either flattening or slight decline. Some think it might crash, but I think that's probably true the longer we're in this thing. But it sounds like Seattle is in general in a good spot based on our audience. And looks like a lot of people have been experiencing buyers pulling out of deals recently due to just fears with the economy, losing jobs, or just lenders changing terms. So let's go ahead and hear from the experts, and I'll pass it back to Leka.
All right, so I would like to talk to Zack first. Zack, let's bring you up.
Yeah.
So Zack, Lazo, and I go way back. When I first started my investing career, my very first flip that I bought from Zack. And I just enjoyed working with him. I thought he was such a stand-up guy. And since then, he's just been such a good mentor, a coach to not just me, but so many people in the industry. Zack, you have so many different kinds of business models. You have a brokerage that you run. You focus on your own fix and flips, as well as finding deals for other investors. So what are you doing in this market to safeguard your company?
For sure. Well, I think that we all got introduced as experts, and the crazy thing is like all of us glued to social media and the news, like we're all kind of becoming like each minute by minute experts on what's going on in the market because it's just changing so quickly. Just exceptions to stay-at-home orders. I mean, we were like high-fiving each other when we, as real estate agents, became essential workforce. So that was a big deal. One of the things that we're doing as a company, though, is like we're really looking at is we need to get kind of lean and mean. Look at what we are as far as our needs are concerned and what our wants are, and really weigh those out. And right now, I mean, the biggest thing that we're doing is just really taking a heavy look at our P&L. How can we safeguard ourselves? And then obviously there's a lot of programs that exist out there for small business owners. There's the SBA loan that's out there. They kind of get, I mean, it's similar to, it's a partial grant if you have some payroll on. There's the 1099 SBA loan that's coming out for the sole proprietors. So there's a lot of different things out there that can help you kind of get through this time, especially if you are deemed non-essential. And so we're just taking a look at what our options are right now. As far as prepping ourselves for success, one of the big things that we're doing is we're getting liquid. The moment that we kind of saw this, and unfortunately it's like no one ever has a crystal ball. Like I was around in 2007 and
yeah.
I was doing real estate back then. I just remember the air died in August of 2007. It just died. And it was like, wait, all I've known is a market that just goes up and buyers are competing, and just died. And so I think that a lot of us that went through that crash are kind of learning from it and are acting with speed. So for instance, some of the tips that I'm telling my agents and kind of investors are get liquid. If you have some equity built up, this is a good time to pull out a home equity line of credit. Not to say that you needed to use it, but man, if there's an opportunity that comes up, it sure is great to have some liquid capital to jump on it. I am kind of more on the conservative range, but I mean, there's some people that say if you do apply and get approved for a home equity line of credit, actually pull that line of credit out. Those of us who were around in 2008, I remember having a line of credit where I had like $200 some odd thousand available to pull out of it. And within, like 24-hour period, there was this wave that just happened where they just froze your ability to actually draw from your home equity line of credit. So they froze your ability to invest, even though there were so many great investments and opportunities to take advantage of. So it's something to think about. I don't want to take a stance on it, because everyone, you got to weigh your own kind of risk factors there. My wife comes from an Armenian family. Her dad paid cash for everything. And it was so like, if it was risky, like don't do it. right? And my wife kind of is the same way. And so even my wife, I got her to convince her to pull out a line of credit on our primary residence. And so that's one small victory for my household personally, outside of my investment company, to get some liquidity available. And even my wife is kind of bought into that thought. And that's kind of how we're prepping.
No, that's great to know. HELOCs, I mean, if you don't have it, I highly recommend going and getting one just to keep you liquid through this process. That's great. Okay, another question for you. What are your predictions for when the stay-at-home order has been lifted? Where do you think this market's going to land?
You know, I really feel like it's anyone's guess. I don't know what it's going to look like as far as people, the real practical functionality of the programs that are there, right? It seems that the government is taking a stance to make programs available and benefits available. So, you know, for instance, Preston, you know, you own a lot of units. I own a pretty significant amount of units. My main concern is if tenants stop paying rent overnight, that's going to be putting us in a pretty tough, you know, position. But because there's benefits available, you know, if they can get those benefits and they can actually get them in a practical usage in time to pay rent, then we're sitting pretty good, right? You know, the landlords can pay their mortgages, you know, and if these SBA loans and some of these other programs supply that need for some of these business owners, then I think we'll be, you know, sitting pretty good. Because I think I happen to be, so, you know, disclaimer, it's an empty office. I'm in my office today. I've decided, like, we're doing like 7 refis. Albert, I'm sure you're working around the clock, but I think that people are going to be rearing to get out of the house. And I've taken a poll right now, even just in kind of our limited, restrictive environment right now, buyers are still buying properties like crazy. Our agents, I did a poll last week, like, hey, what are you guys experiencing on the listing side? And across the board, it was like, this still feels like a crazy market. And I was like, all right, well, okay, fine. I'm sure there's a ton of buyers kind of out of the market now. I'm sure competition has gone down a lot. And I was actually pretty surprised to hear from the agents representing buyers that there still seems to be a competitive environment for the houses that are universal and priced well. So I think that, you know, Albert can probably speak to this, but if rates stay low and it lifts and buyers either have that confidence that they're going to keep their jobs, I think that buyers will come back in the market. But I really, you know, the service industry obviously is going to affect a lot. So I do feel that there's going to be some activity when everything lifts. And Leka, you're frozen right now unless you're just super deep in thought.
That's awesome. Yeah. So let me ask you this. Are you still buying deals? And if so, like how are you changing your buying criteria and how are you coming up with your new ARV values?
So it was tough coming up with ARV values. Was it wintertime of 2019? You know, we hit this period where the market just kind of really slowed down and we were having a tough time. And right now I feel like we're in this really strange window of time. So as a company, we have a program that's called Built-in Buyer. You know, as an agent, you can come in. If you don't have a client, we'll basically be your buyer for you. And we have an analyst that'll kind of set up the numbers and all that. So we kind of buy at will at all times. And about a week ago, full transparency, we shut that program off because we just don't know and can't predict how big that swing is going to be now. So right now, we're pretty skittish on buying right in this like month to maybe 2 month window. I am very optimistic about what opportunities exist ahead, though, because I feel like the public kind of is 3 months behind, right? And if there's this big fear that builds up instantaneously, I think that window has shortened quite a bit. It's gotten a lot more restricted. But if this big window of fear opens up, just like when the market was crashing in 2008 or 9, it doesn't make sense to sell off stock when everything's crashing. Don't sell low. But people sold and they were selling at will. And so I do think that there are going to be some people that sell and they might be kind of emotional and illogical about it. So I think that there will be some deals, even within this weird transitionary period, that are like, okay, this is undeniable. Let's go for it.
So I know a lot of investors right now have flips that are coming on the market in about a month or 2 months. They're in the middle of construction. Construction has stopped, stalled. Any new exit strategies that you can give us or tell us about that has worked for you in the past when something like this happens? Or, like what are you doing to safeguard those flips?
So, and it's the construction industry is so essential. And one thing I would direct you to is just look into the order of exceptions of what work is essential. If your property could spoil, basically like get run down or whatever, there are going to be certain activities that are deemed essential as construction work. If it's a dangerous environment, which most renovations are, especially if you stop it kind of midway, they're going to be dangerous. So I would just leave it on the shoulders of your construction workers on what risk they want to take on as a company. But I would say that a lot of the work that they are doing for our renovations are essential. We have a roof that needs to be put on. If we don't put on a roof, the entire structure is going to, spoil. And the way that it is right now, it's a dangerous site. So we are putting on a roof on a current project and making sure that the electrical is nice and safe. So there's certain things that can be done. I think this is a relationship business first and foremost. I'm sure Charles can attain to that, and Nia, I'm sure you can attain to that as well. But if you've built up a great relationship with your lenders, this is now that time to say, hey, obviously you're getting my next 10 loans. I'm bringing my next 10 to 100 loans to you. What can we do? Obviously, this isn't something that we did as investors, right? This isn't our fault. This is a global thing. And just try to work out something with that lender and say, hey, what are my options? If you're in a stage where you're just about to come onto the market, I feel okay about that. Obviously, your exit is you can reach out to Albert and refinance and lock in a 30-year fix. That's always a good option to hold real estate. But I think right now, the perception of fear may be greater than the actual outcomes of sales. So far, so good as far as properties turning. So, but again, everything's changing day by day, week by week. But I would have thought by now we would have seen a major kind of decrease in sales and an increase in market times, and that just hasn't really been the case, at least across the the 70 some odd agents that I'm talking to.
Zack, thank you so much for your wisdom. We're gonna come back to you at the end of this and ask you some questions from the audience. But thank you so much for being here, and your experience just helped so many investors, so many of us. I'm gonna take it over to Preston Walls. Hi, Preston.
Hello, Leka. Thanks for having us.
Thank you for being here. Yeah, absolutely. So for those of you that don't know, Preston is the OG of property management. He manages over 800 units in the core, like downtown Seattle neighborhood. So I'd just like to know, what is your take on the existing times? Like how long do you expect the domino effects of COVID-19 to hurt your cash flow?
Oof, I see it going on for a while, and yeah, primarily it'll be tied to unemployment data. How long do the unemployment numbers take to recover? In the near term, all of my focus for the last week or so has been on April collections. What do those look like? Where are they going to be? And as of this morning, we're down to 11% delinquent, 11% of April rents that have not yet been collected. And some of those leases have until the 5th to pay before they're late. So I'm feeling fairly encouraged by this, but I expect every month will get more challenging as we go on and businesses are closed and continue to lay off people.
Yep. What advice do you have for landlords and property owners to, kind of that are struggling to meet the needs of their residents?
Boy, I can take that in in a lot of different directions. I mean, in the very near term, I mean, just we're in a crisis. The building is burning. What do we do right now to get through this? And I mean, that is any way to keep residents current on their rent. I think getting to payment plans gets you into a tough situation of you know, it's hard to get current on a payment plan if you are out of work for months at a time. Rent is not your only bill that's piling up. So uh, anything creative, we contracted with a number of our residents who lost their jobs to paint stairwells and hallways. So we traded them hours for rent credit, so they could uh, they could pay the rent or get caught up that way, and that gives them some time while filing for unemployment to get
Right.
other benefits coming in. And then so that's from a tenant perspective. Just from an ownership perspective, yeah, just following on Zach's comments, liquidity is key.
Right.
And I mean, I think one of the biggest risks that owners face the longer we're into this is banking liquidity, and you know, banks are businesses too, and as their credit quality deteriorates, they're going to look to pull back. Pulling back means reducing loans, calling in loans, and reducing credit lines. So reducing credit lines reduces access to liquidity, which reduces ability to make investments. So maintaining access to cash, that's a significant one, and I have drawn on some of my credit lines and just parked it in cash for the time being.
Yeah, so staying liquid, just making sure you have enough to just get through the next 3 or 4 months. Good advice. I know that you own so many buildings and you're also property managing so many buildings. How has your leasing activity been affected?
The leasing traffic has been fascinating to me. So I'd say traffic was fairly active 3 weeks ago.
Right.
And then it dropped, just fell off a cliff to last week. There was hardly anyone out there, and this week, I mean, it is the end of the month, the first of the month. It's typically a higher traffic time, but there's a lot more people looking. I would say a shocking, surprising number of people looking for apartments right now. We have increased prices on some of the listings, and interestingly, the larger multi-bedroom units have had a lot of action. So I don't know if it'll continue, but I'm really encouraged by the leasing data. Another interesting thing that I've seen in the collections data is where delinquencies are falling in. So there's been a fairly direct correlation between quality of the building to tenant quality to ability to pay. So the Class A
Right.
buildings, nicely renovated, kind of high-end remodel buildings, they've done pretty well. And buildings with deferred maintenance or just lower end finishes, lower tenant quality, credit quality, have been much harder hit.
That kind of brings me to my next question. Once this is, we're in this for a few months, what impact do you think it'll have on rental rates? Because if I remember correctly, in the last recession, rental rates grew because people's affordability kind of died. They couldn't buy homes. And so a lot of them switched to rentals. So where do you think that's going to leave us?
I think ultimately this is negative for rental rates. I mean, right now there's a huge shock to the system. Everybody's trying to sort out what equilibrium is and get out of whatever situation they're in to the right situation that they need to be in for the near term. But ultimately, people out of work is less money in the system, less money to spend on everything, and less money to spend on
Right.
housing. And so that's deflationary towards rental rates. And we'll see people getting roommates, moving in with family. So I see rental rates declining. I see vacancy rates increasing, and I probably see, though I'm kind of surprised how little I've seen it in the April collections, but I would expect to see that just delinquencies increase by discouraged renters. Hey, I'm just gonna hang out here. I can't get evicted, so I'm gonna ride it out.
Yeah. So going into the next couple of months, watch out.
Yeah, May's gonna be tough, and June will likely be even tougher.
Right. Well, thank you, Preston. I'm going to give it over to Nee to talk about some lending and, any advice we can get from that would be really helpful.
Yeah, lending is a hot topic these days as well. And I don't know if you guys know, but Charles is my boss. So he and I have talked back and forth about the market and lending overall every single day. And so I always learn a lot whenever I talk to him, and I hope and I imagine you guys will too from this conversation. So Charles, can you give us kind of just an overall idea of what's happened to the lending market recently? Sorry, I think you're muted.
Hey, can you hear me now?
Yep.
Cool. Hey guys, sorry I was on mute. I'm going to start by going a little more macro than Zack and Preston. So historically with recessions, the real estate markets, access to mortgage credit have been very uncorrelated with economic recession and loss of jobs. The one exception, of course, being the U.S. housing crisis, where a breakdown in mortgage credit and rising mortgage defaults led us into the situation. What we found this time just reflecting over the last 30 days, is right around the time COVID started to accelerate people began to self-quarantine in, communities like, San Francisco and Seattle, we saw the credit markets freeze, very much like they did in September of 2008 when Lehman Brothers was allowed to fail by the Federal Reserve. The other thing that we've seen this time out of the gate in relation to the US housing crisis is the Fed has been much quicker and much more aggressive to react by lowering the rate at which banks borrow money, by injecting cash into the economy through purchases of treasuries and mortgage-backed securities, and by reintroducing some additional programs that were created and were very successful in the U.S. housing crisis. So what that's meant for lending is over the last few weeks, I'm sure everybody saw this, there was a lot of volatility in conventional mortgage rates. They're now quite cheap. I checked yesterday, I think rates were around like 3.3 something percent for a 30-year fixed. Albert will confirm that, I'm sure. The reason rates have been very volatile is in February when rates went down, a lot of people refinanced and there were a lot of mortgages waiting to be sold into the capital markets through mortgage-backed securities. And there just wasn't demand. When COVID happened, usual buyers of mortgage-backed securities said, hey, we're going to stick our money in cash, and they just weren't there to buy. And so the Fed has stepped in and is now the major buyer of mortgage-backed securities, as it was through the fourth quarter of 2008 and into 2009. What we're seeing now, and you're seeing this in rates with conventional mortgages, is the market is starting to stabilize. Refinance, of course, will pick up. There's about a 200 to 300% increase in refinance activity year over year. So the conventional markets, I believe, are stabilizing. Now, for folks on this call who are investing, you're not going to get a conventional loan when you're taking down a fix and flip or a property to BRRRR. You're going to local hard money lenders. You're going to somebody like Certain for a short-term bridge loan. That market is very frozen. You guys, I'm sure socially and through the press, have seen that most lenders have stopped writing, 6 to 24-month mortgages. And I expect that will continue for probably another 30 to 90 days, depending on what happens in the capital markets, okay? And to put that in context, I would group lenders into two buckets. You have private money, individuals, you have lenders with private capital through funds they raise, and they'll have a limited amount of gunpowder that they can deploy to make loans. And they're going to start pricing as they did 4 or 5 years ago, where interest rates are going to be 12%, origination points are going to be 2 to 4 points. And I think at least short term, when you are getting a loan, that's going to be reality, okay? There are other lenders like us who combine private capital and financing partners in the capital markets. It's going to take some time for for those sources of capital to get comfortable going back into the markets. The reality is right now, a lot of the hedge funds that bought those loans are sitting tight, and they're managing their cash positions and they're concerned about mortgage defaults. And so they're saying, hey, full stop, let's see how borrowers get through the next, at least 3 months on payments, maybe longer. And let's see how the economy looks in, call it 1 to 3 quarters, before that appetite to take loans and and drive interest rates on those loans down further will start to pick back up. Okay, so I think you're going to be in a waiting period where access to capital is going to be very difficult for call it at least 2 months. When we come out on the other side, I think it's going to look very different. The days of being able to get 90% of your purchase price and 100% of your renovation, whereas a real estate investor, you have very little skin in the game. I don't see that returning at least for the next year, maybe longer. I would expect proceeds to be much lower. And again, I expect pricing to be higher. So when you're thinking about taking down investments, echoing what Zack said, really pay attention to your liquidity. Make sure that you have enough money in the bank, not only to cover your down payment, but to cover all or a good portion of the renovations, and then to be able to make payments for the full term of the loan, and probably beyond that in case you're you have to sit on the market with your house. Okay, and the final point I'll make on this is just around house prices. You know, Mark Calabria, who is the regulator over Fannie Mae and Freddie Mac, was on CNBC the other day. Mark's an interesting guy. He used to be at a Republican-leaning, kind of libertarian-leaning think tank called the Cato Institute. You know, so he's a very free markets economist. But he came out and said that in certain regions, the delinquency and foreclosure rates for Fannie and Freddie mortgages could be as bad or worse than the last housing crisis. He put his comments in context around how long it takes to get the economy rebooted. You know, he said, look, if it takes longer than 6 months for for the economy to open up, you know, people start going back into their offices and whatnot, you know, that's the scenario where he thinks it could be that bad, but otherwise he thinks it won't be. But the reason I bring that up is if we think there will be that many delinquencies and foreclosures, we should expect house prices to correct. I personally think that Seattle will see house price correction. I'm talking here about year-over-year change in median sales price, will probably go down through the end of this year by as much as 5 to 10%. I think in certain other regions, so if you're an out-of-state investor and you're buying like, you know, rentals in say Midland, Texas, I would be very scared. I think you could see much more severe house price correction in Texas with energy. I think the Northeast and New York in particular is going to take it hard as well. And so, you know, those are things that I would be thinking about as a lender around the timing of when I would come back in and commit capital, and as a borrower or an investor, you know, where I would think about pricing my offers on properties, and, you know, how I would look at my liquidity and my resources to get through projects.
Well, that was a lot of stuff. I think you hit several different topics, but I think to kind of end things off, I mean, just based on everything you said, for those who are in trouble right now with hard money, say they're in a hard money loan and right now they're stuck in it, what do you recommend that they do at this point?
So the first thing I would say is I would recognize that when you're in a non-conventional loan, for example, with us, these mortgages are not subject to the same governmental programs that conventional loans through Fannie Mae, Freddie Mac, and HUD are benefiting from. So it's, you know, so coming to someone like us and saying, hey, can I just defer my payments? You know, our first response is going to be, you know, we're all in this together. You know, we understand where you're coming from. You know, we're not a beneficiary of these programs. And so for us to work with you, we really need to understand that there truly is hardship, okay? That's the first point. And along with that, if you're not in hardship, you need to make your payments. Most hard money loans are set up where if you don't make your payments, you're immediately suffering from late fees and default interest, and that gets very expensive. And then what I would say is if you're in a situation where you can't finish a project, you know, be prepared to work proactively and have, you know, an honest conversation around the best path forward. Payment deferrals from a lender perspective may not be the best thing. You know, taking that project and, you know, assigning it to somebody who can quickly finish it and, you know, get the lender paid back, hopefully get your down payment back to you as the borrower might be another option. But I think the key point here is, you know, one, just be transparent. Two, you know, be prepared to have kind of candid, proactive conversation. Three, you know, just, you know, I think any lenders looking at the situation is it's in their interest to problem solve with you. Certainly from our perspective, we'd want to problem solve with anybody. We don't want to play gotcha or be punitive. And I think if that sort of constructive engagement and dialogue happens, you know, hopefully it works out well for everybody. Nee, I don't know if you have thoughts you want to add to that. I mean, you're on the front lines.
No, I think lenders understand that they need to be lenient, right? And I think extensions are going to be, they know they're going to have to grant some of those, right? How much it costs, I hope lenders will be kind in that. But just keep in mind is that the last thing you want to do when you're in trouble is just not communicate to your lender, right?
Yeah. And
communication is key.
Yeah, and let me actually jump in on that point about extensions. So we, we have some borrowers who have come to us and said, hey, we need extensions. They have loans maturing in like the next month or two. They want extensions. We're, it's on a case-by-case basis, but we're doing free extensions. So, for those who need it and truly can't pay off the loan, we're saying, look, we'll just extend you for, like 3 months, 6 months or whatever to get the project finished. Because again, to Nee's point, it's in everyone's interest to get these projects done, get them out into the market, and get optimal net proceeds from sales quickly. So that's to Nee's point, charging extension fees right now just doesn't seem productive for anybody.
Awesome, thanks, Charles. That was a lot of information. Let's move on to Albert in this last section before we get to the Q&A. So Albert's, obviously one of my go-to guys for conventional financing. Whenever I have a technical question and I don't want to read the 2,000-page rulebook, right? Albert seems to know them all. So Albert, can you let us know what's happened in your eyes of conventional lending over the past couple weeks?
Hey guys, how's it going? I'm Albert from Avenue One Capital. So I'm a mortgage broker and active real estate investor in the Seattle area. I'm dealing with clients every day and mainly real estate investors. So I still do primary OC and second homes and all that, but it's usually for the investor that wants those types of homes. But what I'm seeing right now is a lot of people are still moving forward, but there seems to be a mad dash for cash out refinances. Everyone wants to tap that liquidity, which all the other panelists have mentioned already. Through lines, where we're looking at first lines of credit, second position where it's sitting behind a main mortgage. We're looking at all sources to prepare beyond just the liquidity part, just saving your cash, of course. We're looking at adding lines and taking out loans. Some people are balanced, so we don't want to take out everything because they're afraid they can't even make that payment. So we'll do a smaller version. We'll mix and match. Maybe we take out a line for 100, but we only pull 20 of it. Keep the other 80 or 50 or whatever up to their specific parameters that they can handle to weather the storm and to ease their anxiety, of course. In terms of the lending and the rates, it's been a huge whipsaw. I mean, we were down to like 3, maybe 2.8. These are for owner-occupied rates with perfect credit and lots of equity, of course. And they were all the way up into like the mid 4s to high 4s. And this is all within 2 weeks. So you can imagine somebody calling 2 weeks ago, hearing 3, and then now they're hearing 4.25 or 4.5, and they're just freaking out, thinking I'm trying to pull one over on them. But that's not the case. It's just the markets are that crazy. And now we're back down to 3.25 and 3.125 for the best scenarios. So it's very interesting, and it's only been 3 weeks. So that's what I would say about the market right now.
Awesome. So I have had a few people tell me they're seeing like programs going away or guidelines tightening. Can you share some examples of that?
Yeah, there's some lenders we've been submitting our loans to because we operate as a broker. So one I won't mention right now, but will not take rental income, for instance. So they're saying that if you have rental income on your tax returns or a rental that you just acquired that's not on your tax returns, that they won't even use income to that. And I guess their position is that they're so afraid of rental income given the mounting jobless claims that we see every week, 6.6 million just yesterday, right, or today. And they're saying we don't trust where the market is. We don't want income that originates from rentals. And we'll take self-employment, we'll take W-2, we'll take all that, but we don't want rentals. And there are other lenders who are saying, if you give us 6 months of expenses per property, that will use your rental income. So basically, if you show us that you have a lot of reserves, your rental income is cool. It's not that Fannie Mae or Freddie Mac has changed any of their guidelines, it's lender specific. So each lender has their additional guidelines they're adding. We call those overlays in our world. And every lender is different. Some of them have no changes so far. Some of them are doing no lending except for conventional. Some of them won't even do any jumbo. All of that qualified mortgage, or some have heard a non-QM, we call those a non-qualified mortgage. It's just a definition for a type of loan. Generally, conventional FHA loans are considered qualified mortgages. So non-qualified is anything that falls out of that bucket. Some people call it subprime. It's all fit into that bucket. But all those loans are gone pretty much. I haven't seen any activity. All my account execs from those lenders have stopped calling me. Usually they call me every week, multiple times a week sometimes. And so a lot of my investors now, we're doing full doc, and that's what's been going on lately with the rates and the lenders.
So as I understand, rates are still low right now, but I've been hearing people starting to get charged points on some of their loans, right?
Yeah.
And especially some of these other programs that are, non-vanilla, like FHA and all the Burr stuff. It sounds like that's true.
Yeah, well, what's kind of like what Charles alluded to was that the pricing in the market, the lenders are scared right now. They're not sure how to make their bets in the market regarding rates. So they're limiting how much credit they're offering in the rate. So every lender starts with a whole rate sheet. We have everything from the 2s all the way up to the 4s and 5s. And each of those brackets will cost a borrower or give a borrower back a credit. And what happens is the lenders are limiting all their credit. So it's hard to price an investment scenario that has a lot of adjustments. Like if you're doing units, if you're doing cash out, maybe you don't have perfect credit. So you have a lot of adjustments for your credit. Or maybe you're doing an investment property. So all those types of transactions need a ton of credit to offset. And what the lenders are doing is they're not offering very much credit to us. And so we have to factor all those credits in, and it's resulting in a large amount of points to do, especially lower credit fourplex cash out, for instance. That scenario would have a lot of points, or anything that is units and is a cash out on conventional. So that's the reason why we're hearing a lot of points, just because the lenders aren't offering so much. It has to do with many factors. One of them is the risk of early payment default. They're afraid that when they originate these loans, that they might not even get paid the first mortgage payment. So because of the jobless claims, there's millions of them, right? So that's one risk. The other risk is the EPO, or early payoff risk. They're afraid that rates will keep going down and that the borrower will refi within 6 or 7 months. Because the average conventional loan, lenders tell me, I don't know because I'm not a lender servicer, they don't break even from servicing revenue from doing these loans till year 3. And I think that's an average. Maybe some loans, they break even quicker, some longer. But when a borrower refinances in 6 or 12 months, they basically lose money. And that's what they tell me, of course. So there's that risk. Early payment, early payoff risk, people paying off early, they're afraid. So they're limiting their amount of risk, credit, that they're giving the borrowers, because they're thinking that everyone's going to continually refi down the way. The other risk is, of course, employment risk as well, and the macro economy, which Charles alluded to. So those are the main risks I see why they're justifying their pricing. Got it.
So I'm curious, and what's your most popular product right now, and what are your timelines look like for closing?
It's what do they say when you're a car salesman or something? You got to sell what you got, right? You used to have a blue Mazda, so you got to sell the blue Mazda. But in reality, joking aside, we pretty much only have conventional right now and prime FHA. Even all the FHA below 680 and 620 is really hard to reach at right now. We're having trouble doing it. The lenders are making our life really tough. So they're adding more conditions, and the general borrower that does an FHA loan doesn't have these kind of reserves. So it basically precludes you from doing it, because if they're going to ask for 6 months reserves on a borrower who's barely putting down 3%, how are we going to, do that? So it's only the prime FHA, I would call it. People who are using FHA strategically, they have great credit and down payment, but they just want low down. Or they have another reason debt to income. So basically that, conventional and FHA only right now. A lot of my lenders have pulled back even on VA. Some aren't doing any conventional. And like I mentioned earlier with the non-qualified mortgages and the jumbos, those are all pretty much gone. If you need a jumbo, you're probably going to go to a big bank like a Chase, Citi, Wells, and hopefully you have a relationship with them, so you'll get that pricing, the relationship pricing.
Okay. And how long are loans taking to close these days? Because I know there was a backlog for a while.
I'm probably averaging about 25 to 35 days on most. Some are longer because, you know, we need documents, and a lot of the lenders are asking last minute items because even the underwriters don't know. It's working its way down the pike from senior management to the senior underwriter to the underwriter 2, underwriter 1, and they don't even know what they need. So sometimes they approve a borrower, but they were told, hey, ask another pay stub. We don't know if this borrower is still working. Ask for another 2 weeks. You know, the old guidance was that you could close a loan with 60-day pay stubs, but now they want pay stubs within the last 2 weeks and another verbal check right before docs go out and another employment verbal check right before funding, just to make sure that the person is still at their job. So it's getting crazy. It's getting a little crazy, like 2009 to 12 all over again, but I've been there, so let's bring it on, right?
So it sounds like overall it's harder right now to get a loan, obviously, than before, right? What
Yeah,
kind of suggestions do you have for buyers making an offer right now? Like, do they need to restructure their contracts in any way?
Not their contracts, but I guess there's that COVID addendum I saw, right, with Northwest MLS. Have you seen that? Or
The force majeure.
Yeah.
yeah, I don't know how it affects the PSA or purchase and sale agreement, but I heard there's some kind of addendum for COVID.
Yes. The
But
22 FM.
okay, yeah, but in terms of lending, what I would say is get all your ducks lined up. We want all your letters of explanation, all your documents, even more so than prior. Prior, I would say, yeah, get your income and your credit and you source your down payment, figure out where it's coming from. Don't wait till the last minute. Because there's so many little things coming up down the pike that we're all going to have a mad dash at the last 10-yard line, basically, because there's so many items. We want to be ready so that when those extra little items come, we're ready to close quickly and we can execute. We're not going to fall out, you know, because I've had people cancel already for the COVID related issues. I've had many pre-approvals that were super motivated, telling me their family story, they wanted to buy. And then now they're saying, no, I'm waiting. So it's gone cold, a lot of them, so.
What do you, maybe just based on experience, because I know you did some lending back in the last crash. What do you think, I mean, how fast is it going to take for us to get back to our old ways of lending and financing in terms of mortgages?
Yeah,
6
I
months,
wish I was a
maybe?
crystal ball owner. I'll have to search eBay for that and, you know, do the buy now option so I don't have to wait, right? And Amazon Prime too, right? Now it's taking 7 days on Amazon Prime instead of 10 minutes.
Right.
Yeah, so I wish I had that. Yeah, I don't know when it will go back. But my clientele have mainly been conventional real estate investors in their homes and their second homes. So I generally only do FHA, VA, and the jumbo only to accommodate. Or if they're a vet and they're investing, we'll use VA to do a house hack on a fourplex and they'll live in one unit, for instance. But I'm not leading with those products. So to me, it hasn't been that much of an effect. However, it does suck to lose some of your tools that you had in your toolbox. So it's like somebody took a wrench away and now you only have the Phillips head, you know, or the flat head. So that part sucks. But in terms of getting back, I don't know. Last time it took from 08, it took probably 5 years to start seeing those qualified mortgage non-QM type loans. To about 2015, 2016, I started seeing those. And that was what, 08 till 16, so 8 years actually. 8 years till the time I started seeing that type of product and all these different creative loans. So I don't know, that was history though, right? So we'll see how this time works.
Wow,
Yeah,
that's
Albert, I don't
insane.
think the non-QM market's going to come back anytime soon.
No, I need those, Charles. Yeah.
All right, guys. Well, I think, thank you everyone for the personal one-on-one interview. We're going to start opening up the questions from everyone right now. And we already had some come in. So let me take that first one. And this is from Michael. Michael's asking, hey, if we have a HELOC, should we take a draw on it and just hold that cash and pay the interest to ensure we have dry powder for investments? What do our panelists think?
Zach, I'm going to throw that to you, or Charles.
You want it, Charles? Go ahead.
No, Zach, go for it, man. You start.
Obviously, you know, there's some risk there because you don't want to be in that situation where you feel, I guess here's the risk, right? If you miss out on an opportunity because your HELOC is frozen, that's going to hurt more, in my opinion, than paying the payment for the next 2 months and, you know, and then having to put it back in because everything kind of frees up again. So in my opinion, I draw on it. That's me though. I'm an avid investor. I'm constantly looking for deals. So that's my answer.
So I'll share my own perspective. So first of all, I always counsel clients, never put your primary residence at risk. That's just my attitude. Setting that aside, like let's say you have a second home with a HELOC on it or an investment property, I would agree with what Zach said. If you're worried about the bank freezing the HELOC as like what happened in 2008, it may make sense to draw the cash and, you know, park it in an account. The other thing I would model out when you look at any investment is calculate your debt service costs, not only on the HELOC, but on the investment you're taking down, as well as your other debt obligations as an entity, a business entity and an individual. And I would, just as a rule of thumb, if you think you're going to hold a project for 9 months, double it and make sure you have enough liquidity to, you know, see through that. And have that factor in not only to do you take down the investment, but, you know, determining if you can afford it or not.
Interesting. Okay, I have a question for Preston.
Yes.
What do you do about tenants that are delinquent now and are month to month or have leases that are expiring soon?
I would do anything possible to give them the incentive to move on their own, whether that's waiving lease break fees, waiving future costs to help them get to the right place, because the value is in getting the right tenant into your building. That helps you with future financing. It helps you with cash flow, and maybe that's waiving some of their delinquency cost in exchange for a notice to vacate. In normal times, I would not have so much flexibility, but these are much different times, and I think the most important thing is getting the right tenant in the right space.
Thank you, Preston.
So I have a question. I think this is be a good one for Albert and Charles, because I think you guys kind of look at the overall national market.
Do you want me to answer the HELOC one first or no?
Actually, yeah. If you go for it.
Yeah, I would, because I deal with all sorts of personalities and philosophies on finance. Some are like no debt, like what Charles mentioned on the primary. Some are like, I jokingly put leverage to the hilt, guys, joking, right, in the Zoom chat. But some are full max out. What I would say is we want to take a global cash flow analysis, kind of like what Charles mentioned too, figure out what they can pay and what they anticipate the pullback might be in their income, especially if they're a landlord, owner of many apartments or units, because we want to figure out the vacancy or the job or wherever the income source is from and see how much we can cover, not just in the months or 9 months or 6 or 10 or 12, but also how do we optimize that? So in mortgage planning, what we do is we'll look at everything. We'll look at how much you're paying on your cards. We'll try to consolidate it into lower rates so that we can take that extra savings and we can allocate it to pay the line. So that way you might be able to hold your line, max your line out for free, cash flow wise, because let's say I save you $600 on consolidating your cards into a loan or into a rental, for instance, and we take that $600 and pay the HELOC on the primary. So instantly we create that savings to hedge against the use of your entire line. That way you have the cash liquidity from the line and you covered the payment instead of just paying it from your W-2 job. You know, now you have to work more hours just to maintain your sanity. So things like that, it's case by case, but we would do things like that to put people in a better position. So that's what I would say. But I would talk more about rents when it's an investor. If it's a salary only person, I'll talk about consolidating debt or maybe getting a raise, but that's kind of hard right now. So.
Awesome. And I actually would also caution too that, you know, knowing that right now it's getting harder to qualify for loans in general, just make sure that whatever creative financing strategies you're doing, you're always keeping an eye out on your, obviously your DTI and your credit score as well, right? Because right now the people who can get the easy loans are the ones with perfect credit at the top of the tier, right? And sometimes when you move things around in different credit lines, that affects your credit too. So just keep that in mind. I have a question here. So which areas of the country do you think would make good rental purchases when we come out of this COVID-19 outbreak?
Hey, can I start on this one? Because I have a very strong point of view.
Yeah.
You know, we know a few people in Seattle who invest out of state in low value properties, and I'm going to call that nationally houses with a purchase price under $75,000. I would very strongly encourage anybody who owns those investments to get them certified for Section 8 tenants. And I would strongly discourage anybody from looking at the lower price band for the next 6 to 12 months at a minimum. What we saw in the 2008 to 2012 time period is the lower price band, and it was $85,000 was our inflection point at Freddie that we modeled. What we saw was, one, huge run-ups in vacancy rates. Two, tenants or former owners leaving those houses in terrible condition where really the structure was worthless and it was only the land value. And three, as a lender, it didn't matter when you foreclosed, like the cost of carrying the property was, you know, in 1 to 2 years became more than what you would recover by selling it. If you're investing in that price band, I think it's very risky right now, and I would be very cautious about it. And I'd be taking steps through, for example, Section 8 readiness to be able to replace tenants with those who will have government assistance.
Cool. Leka, you want to go?
Sorry, I was muted. This is for Zack. Zack, what do you recommend right now, a flip or a long-term rental to purchase?
That's a great question.
What is risk?
Right now, I'm a little bit of an observer right now. If you can secure really good financing terms, because that's a lot of what I'm hearing right now is if you can secure really great financing, maybe that's if you're in a long-term hold, as long as you have a great enough margin between what your payment is and what your rent collected is, maybe I'd think about the hold just because you are securing great financing terms while it's still there. As far as a flip, it's not anything that I would ever take off the table, right? Because in any given marketplace, there's a deal to be had. It's all just price driven. So I would consider a flip, but oh my gosh, I would be a whole lot more conservative right now with everything. Just, you know, hold times, construction costs. One thing I will say, the benefit probably will be that construction costs will come down. Other costs probably will come down. I remember when we first started flipping houses, 10, 11 years ago, the amount of work that you could do for $30,000 or $40,000 was just, incredible. Whereas $30,000 to $40,000 gets you a kitchen nowadays, So I think that there's opportunities in every marketplace, but I would be really conservative.
Yeah, and I also want to add that, like Charles said, just double your time. If you think you can get it done in 5 months, really account for 10. That'll kind of give you a good cushion.
One thing I do want to say though is this is such a good time right now because a lot of people are pulling their money out of stock market or convert it to cash, or in my opinion, there's a lot more opportunities to seek out funding partners too, just to kind of cover that extra funding need. So, and everyone's watching, and people are available to talk to. And I think that for us, what we're pitching as a brokerage is that I want to have a sense of empathy here because obviously as markets get volatile and as the market goes down, these are real people in real life situations that are having tough times. And so I don't want to just glaze over that. It's tough. It's going to be tough for a lot of us. But the fact of the matter is there's going to be opportunity. And so we're gearing up our agents to get ready for opportunity. And this is where being an investor, it is exciting because there are going to be opportunities. So if you have people that are watching within your sphere, this is a great time to get funding partners. People that I think people think of real estate as more reliable right now than the stock market. And I get it, Charles. I think if you look at the last, five or six recessions, it's not always tied to real estate decreasing along with the recession, which I do agree with Charles that we probably will see a bit of a hit to real estate prices. But I also, in my opinion, I think it's a little bit more of a condensed blip. Leka, couldn't hear that last thing you said.
Oh no, I said thank you. Sorry. Oh. Ferris, I don't know where you are, but if you want to ask your question, maybe to Albert, go ahead. Did we lose him? Maybe.
I think I answered it on the private chat, but
perfect.
Yeah.
It's active over here on this chat.
Yeah, I'm typing.
Yes. Any other questions?
Well,
this is great.
As a general question, because I think we've had another similar question right now. People are basically saying, hey, this is what I'm getting for my rate. Should I keep shopping around for a cash out refi, or should I just take it?
My question for me or who? Charles?
Albert, you want to take it?
From a conventional point of view, as an investor, what are you going to gain? Like an eighth, a quarter? It's not going to be that big of a difference between me going to United Wholesale Mortgage, Wells, or Quicken, or CMG Financial or Home Point. All those lenders, they're all great, but it's only like an eighth or a quarter max. If I'm at a 12% rate with multiple points and my extension is coming up in 3 days, I want to order those loan docs and close ASAP, but that's me personally. So I'm not going to shop for an eighth or a quarter if my risk is 2-point extension and continual 12%. A lot of the lenders, the default clause goes, I'm not going to step on you, Charles, but a lot of the ones I've seen on the payoff have gone to 24 to 29% default rate when you go over the 6 months or the 12 or whatever it is. I've ordered loan payoffs where I've seen 29.99% or whatever. So that's my thought.
Yeah, Albert, I would echo what you're saying. Look, if you're doing conventional, I'd lock into an option that you have versus continue to shop. The other thing I would say, Albert, you're closer to this than me, but it seems like every few days we see lenders coming out with additional credit overlays. These are not requirements. Look, Fannie and Freddie have taken steps, including loosening employment verification, income documentation and appraisals to make it easier to do mortgages. But as Albert correctly pointed out earlier, certain banks or lenders are putting in overlays to reduce their risk profile because they have to service these mortgages. So I anticipate that'll keep happening. And if you have an option, I'd lock into it. Even if you have like a 3-year prepayment penalty, you might even be better off locking into that if the rate is good and just, look, if you can refinance at a much cheaper rate in 6 months, you just pay the prepayment penalty and, recover your money over time. But I'd definitely lock into an option versus shop around at this point.
I'm not in the mortgage market, but just from an investor standpoint, I would expect every day that goes by, getting a loan will be incrementally more difficult as just perception deteriorates, as unemployment increases, and liquidity is more challenged in the market.
Actually, Preston, I have a direct question to you because we've been talking about kind of bridge money and conventional money, right? You're in the kind of the commercial space. How has financing looked like for you over recently?
Oh, it's been tough. I've had deals implode, blow up, spreads have blown out. Everything has gotten more difficult. Underwriting standards, lenders have typically been at a 125 debt coverage ratio. That's gone up mid-application to 130. Fannie and Freddie are requiring 12 months of prepaid principal and interest payments. Chase on the commercial side, they're underwriting a 10% vacancy rate on their deals. It's really tough. That's why I advocate if you've got an option, take it, because the future does not look good.
Can I speak toward even just the sellers that are in a position where they're selling their flips or like they're right about to sell their flips too? Like,
yeah.
What I was going to say is just with the uncertainty of the lending market, one thing I would suggest for you sellers out there who have an active listing or just about to list your flip and you don't see any other type of exit strategy is just make sure that your listing agent is covering every single hole in that contract. And one of the things I would really encourage is to go for certainty over price and to scour that contract for holes and to make sure that buyer has done a significant amount of due diligence and done their homework on the lending side, get in contact with the lender, find out exactly what their qualifications are. Are there anything that are going to make their ability to get that loan difficult? And I would just be putting a lot more work into and select a lot more carefully which buyer you're going to let in that door. And right now, certainty is way up here as a priority versus price on our listings. As a brokerage, we are seeing buyers start to get shaky feet, and those buyers agents are pointing to holes in the contract and using those to back out. So high earnest money, make sure your contracts are airtight. There is a clause in the NWMLS forms that you'll want to know if you're a seller. It's the 22 FM, it's the force majeure. More or less, it's saying that factors outside of everyone's control, acts of God, are now putting limitations on how people can perform on their contracts. If you're a buyer and you're feeling kind of shaky about a contract that you're in, and it wasn't part of your normal offer. It's something that you can add into your offer, but you need to get buy-in and a signature from that seller. There is some playing room within there. They basically just extends out every timeline. So you get pre-approved with Albert. You get allotted a certain amount of timeline to be able to perform on that financing. This just extends that financing contingency period. Same with any inspection periods, any other time periods that you're unable to perform on due to what's going on. It just extends that. One thing I would say, if you're on the buying side, if he extends closing past 14 days, which is that default, if the buyer is unable to perform on that, the default of that force majeure contract says contract shall terminate, earnest money shall be given to buyer. That's great if you're on the buy side and you don't know whether or not your buyer is going to be flaky. If you're on the seller side and you're the one getting that, right, because your agent may not be familiar with that form, but if you're on the seller side and you get that form, you sign off, okay, sure, I'll give you an extra 14 days. Just know that if this stay-at-home order and they're part of that non-source essential workforce and they cannot perform on that contract, it automatically terminates and that buyer gets their earnest money back. So you're waiting around for nothing and there's no real, money that you're getting for waiting around. So just be careful, watch your contracts, make sure your agents, make sure you're working with agents that are really detailed and understand that.
So do you recommend that we take backup offers then?
Oh, yes, I would. I would definitely recommend, for sure. Yes, okay. Talk to everyone. This is, your agents are earning their money on the listing side right now, for sure.
Awesome. I think if we don't have any other questions, we're gonna end this with one last question to all of our panelists. What do you recommend that investors do right now to kind of prepare ourselves for the upcoming months? Charles, you can start.
I would get yourselves organized. Financials, any documentation needed to, handle your taxes, deal with lenders, for example, receipts for construction draws. And I would have a budget related to that, kind of know what your expenses are for the next 24 months, your incoming cash flow, and I would free up liquidity either to make sure you have a cushion for the next 2 years, or as Zack in particular has alluded to be able to jump on opportunities.
Zack, you want to go next?
Yeah, I think this is, and I'll just kind of piggyback off of that. This is the time to really look at your personal finances, right? Just look at everything in your own budget. A lot of us for a long time, we've been doing really well. The markets, we're kind of riding the good wave of the market, and so we're not maybe paying attention to our budget quite as closely as maybe we always should have been. And so the shakeup is maybe a great opportunity for you to look at your family's personal finances and just look at need versus want, and just be really aware of what is available to you at your fingertips. And one really good thing that's kind of helped me in this is just it's a relationship business. Reach out to your network. Hey, what are you doing? What are you doing? Have you heard anything? Is this information that I got, this site that I got from 8 hours ago, is it still up to date? Like, talk to the people in your industry, people that are successful, and find out what they're doing too and how they're pivoting during this time.
Preston, what do you think?
In a word, I would say breathe. Maybe some yoga, meditate. I mean, in the short term, very short term, you got to make sure your properties are operating fine. You're collecting the rents. You're building your liquidity position. But looking at the last downturn, stocks put their lows in 2008, but the apartment market didn't bottom until fourth quarter of 2010. It was 2 years later that you would have been catching a falling knife that whole time. And during that time, it's so hard to know where and when the bottom's going to be. So there will be some great deals coming out of this. They're probably not going to be in the next 2 to 3 months. So I'd say have some patience and just watch it and be ready to jump in.
I personally love that you mentioned yoga, because I think we are all beating ourselves up for what's going on, and it's really not anyone's fault. So I really think just taking this time to kind of reconnect with yourself and your families, and what's going on is just way beyond what any one of us can control. So just taking some time to reconnect with yourself, I think that's important in the short term. Albert, I'm gonna put the same question to you.
Coming from a lender, working with lending, and I would say back to what I think I said originally, getting ready. Personally, I always get my financials ready. It's not just for conventional, my own money. I'm getting ready in private money. I'm getting ready in commercial. I'm talking to all the lenders. I keep my pre-approvals with 3 commercial lenders at one time, personally. So that way I could take out my loans or pay off my loans at any time. And who knows, maybe all 3 of them will go down, who knows, right? But at least it gives me a higher probability of execution. And that's how I do my planning. That's how I do it for the clients as well. I tell them always have a plan A, B, C. I tell the realtors that too. Like, if we don't close with plan A, I have plan B, C, and D to close this deal. The question is, can we emotionally keep the buyer and seller together to close this? That part I can't control. I mean, I can try to talk to people, but but in terms of the strategy, I generally like to have that engineer mindset. My background is computer science, so I like to have the redundancy of knowing how to execute in multiple scenarios personally. So what I tell people is back to liquidity, of course, that's the number one, but there are backups too. Do you refi your money out? You're stuck in a hard money loan. Who's going to pay it off if conventional declines you? What happens if the way the lender looks at your debt to income is too high? Can you look at debt coverage, the commercial way of underwriting? Can you pay it off with debt coverage method? Look at both methods. And most conventional or residential lenders won't know how to look at debt coverage unless they're an investor themselves, or they're brokering commercial money as well. But that's what I would say. So there's a little bit nuance to it.
I think me just posted everybody's information on here. If you guys want to connect with us offline, please feel free to. I'd love to hear your feedback, the good, the bad. You know, if you want us to continue to do this, just email us and we'd be happy to bring you other speakers, whatever topics you want to talk about. But I want to thank you also for attending. It's nice to see everybody, and you know, just this helps me focus, and I hope it helps you focus. So thank you for being here. I want to thank the panelists again. Great information. And we'll see you on the other side. Just stay safe and stay home. Let's flatten this curve.
All right. Thank you, Leka.
Thank you.
Guys.
Thank you.
Bye, everybody.
Take care, guys.
Thank you.
See you guys.